Let me begin by explaining what technical analysis is all about. There are two ways in which investors, traders, professional traders, try to play the market. So one is by looking at the fundamental data, and other is looking at the technical side of the market. Technical analysis at a very basic level, it is a study of market action. Basically, what we are doing is recording the price information in a graphic form. The visual impact that we are trying to capture, it is so good that just by looking at the chart, we are able to know what is happening in the market. It only looks at the price action. It tries to identify demand and supply in the market, and basically, it is a study of how prices have behaved historically. A technical analyst, who is also called as a chartist, he focuses on the study of past market data, basically price and volume. What the chartist is trying to do is gauge the market sentiment, the market mood, and tries to find out whether the market is likely to be bullish or bearish. In the short run, it is emotions which drives the market. So what the chartist tries to ascertain is he tries to understand the emotions in the market by studying the market action. So they use a series of indicators, chart patterns, etc. Technical analysis is based on the study of these four things: the trend, the price, the volume, and all these over time. Technical analysis has got nothing to do with fundamentals. It has got nothing to do with balance sheet, the macros, the profit and loss, the cash flows, etc. Unlike the fundamental analyst, who will do a detailed series of analysis and calculation, and he tries to find out the correct price of the share. So there is no effort here to find out the intrinsic value of the stock. Fundamentals tells you the story behind why a stock is likely to perform, and the technicals will help you in entering the market at the right time. The market has three stages. It could be upwardly trending, it could be downwardly trending, or it could be moving sideways. An upwardly trending market is what we commonly call as a bullish market. A downwardly trending market is what is referred to as a bearish market. And a sideways market is a market which is largely range bound. It's going nowhere. It is moving within a narrow range, sometimes going up, sometimes going down. A hardcore technical analyst really does not believe in the fundamental side of the story, because he says that everything is reflected in the price. Price is supreme. So any good news, historical news, any forthcoming news, future news, everything is there in the price itself. So the price captures everything, or in other words, the market price discounts everything, every possible information that is available in both public and private domain. Price normally moves in trends unless the market is sideways, but then the markets do not remain sideways for a long period of time. Eventually, it would take a trend, either an upward trend or a downward trend. One of the fundamental assumptions of technical analysis is what has happened in the past is likely to be repeated in the future. So history repeats itself. Few important pearls of wisdom. This is really thought-provoking. You make 80% of your money in 20% of the time, and the rest of the time you just have to be patient. This is actually very true, but it does not happen like that. Probably one of the most famous sayings in this market: far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections. Okay. Peter Lynch, one of the greatest fund managers of all time,